A week from tomorrow is the tax filing deadline. Last week we ran through a variety of situations that were unique to the 2020 tax return. This week we're going to share with you some other more disturbing statistics when it comes to dealing with the IRS. For those of you who have already filed your taxes, some disappointing news in terms of the speed of the refunds for some of you. So if you haven't got your refund, you may be wondering, well, where is it? We've got some stats that we'll share with you that might help to explain why you haven't got your refund. Combined with the fact that we'll ask the question about why Americans can't get enough of the stock market these days. Plus, we'll also talk a little bit about the Florida retirement system. There was an article by the folks at Wesh News here in Orlando about the state of the Florida retirement system pension plan. So you certainly want to listen in to all of that. Welcome to our program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program. Recently expanded our network to pick up the folks over on the Space Coast at WMMB 92.7. You can also hear us on our old stomping grounds of News Radio WFLA Orlando, along with 96.9 The Game. If you somehow can't get to a radio, which is in pretty much every car, you can always check us out on the internet as well. That's pretty much as ubiquitous as a radio these days anyway. Be sure to subscribe to any of our podcast channels on your favorite podcast platform of choice. So make sure you check us out on all of that. Of course, my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces not just superior investment results, but also provides you with peace of mind for the future. So the reality is that there are major problems this season processing tax returns on behalf of the Internal Revenue Service. Certainly there is a high volume of 2020 returns that are requiring manual processing. And that has to do with the stimulus checks that were sent out during the course of last year. 2 rounds, one in sort of that May-June timeframe, and then the other one right at the tail end. Many of folks got it actually in January, but it's actually a 2020 item. So between those 2020 returns that are having to be manually processed, the backlog of unprocessed returns from 2019, all of those paper returns, that's why we encourage folks to file electronically. If you're still putting a stamp on the old envelope and taking it to the post office, the reality is that that's going to delay the processing of your return. And then, of course, lastly, these congressional mandates to generate out these stimulus checks. 3 rounds of that certainly was much more activity for the IRS than they had ever had to deal with before. And so one of the more unique issues on the 2020 tax return, and we talked about this at length in prior programs, but it was those stimulus checks for 2020. And what we ran into here at the office is folks sometimes don't recall whether they got it, or it might have gotten deposited, or maybe they got a debit check card, or maybe they got a check or whatever. It's just easy to kind of lose track of that stuff. So the reality is that there's a way to true it up if you didn't get it, and that's through the recovery rebate credit line on the 2020 tax return. But here's the problem. If you don't remember whether you got it or you got it and you forgot that you got it, the reality is that if that data doesn't match up, that means that your return is getting pulled for a manual review. Stop and think about that for just a second. That means that somebody is manually making sure that the numbers match up. As you might well imagine, that is a highly inefficient process, but that's how they are dealing with it. And so this manual process where you're adjusting the refund of the balance due, for any discrepancy between what you got and what you said you got, that really is bogging things down ridiculously. So, and we're going to give you some statistics on it. So, when a return gets pulled for manual review, it goes into as part of the IRS's Error Resolution System Unit, the ERS unit within the IRS. That's the one that just basically kind of makes sure that when things don't quite match, it gets pulled for manual review. Well, this year there's a lot more of them getting pulled for review because of this discrepancy. In fact, here are the numbers, and here is how big the queue is that still needs to be reviewed and processed. As of the week ending April 9th, 2021, so about data from about a month ago, there were more than 8 million individual returns that were in suspense status awaiting review and manual. 8 million returns. To put that into perspective, during a normal tax season, when that error resolution system is fully operational, there's no suspension of returns. They're able to kind of keep, the folks of the IRS are able to kind of keep up with the flow that's coming in. And so there really isn't any backlog. Well, this year there's a queue of 8 million returns, along with a bunch of other returns that need manual processing. 5.3 million individual returns from 2019 and 2020 that were done as paper returns. Again, folks of you out there that are still doing paper, you're the back of the line, if you will. And then another nearly 5 million returns with processing errors. Basically, you have a child that you put on your return, and lo and behold, they went off and filed their own return. And so that creates processing issues or fraud detection issues. So there's another almost 5 million returns there, and then another 11 million business and other returns. So basically, in total, if you add up, the IRS is sitting on 28 million tax returns for manual processing. That is a massive amount of backlog. Here's the other sad statistic. If you're looking for a refund, you've just got to be patient, because there's not really another choice. You can't call. Here are the numbers right now for the IRS in terms of phone calls and calls processing. The IRS has seen an increase in calls to its account management toll-free lines at over 300%. So people are anxious about it, and so they're calling, and that's creating more and more call volume. And then as of April the 10th, 2021, IRS employees had answered about 2% of the roughly 70 million taxpayer phone calls on the IRS's 1040 telephone line. To put that into real numbers, your chances of actually talking to somebody from the IRS when you call the line is about 1 in 50. So if you haven't gotten the refund, understand there's a backlog of 28 million returns that need to be manually processed. There is a ton of returns that are having to be manually processed because of discrepancies. It just people forget, or they got it, or they got a debit card, or maybe they didn't get the debit card, or whatever the case may be. There's a much bigger backlog than ever before. What do you need to do involving that? Well, other than be patient, I think there's certainly some ways that the IRS could improve how it is doing, starting with just maybe being able to communicate a little bit better for taxpayers, to be more transparent as to where the status of taxpayer refunds are. If they're being pulled for manual review, you should be able to know that and find out, rather than just get crickets. But unfortunately, the IRS given a lot of crickets these days. Anyway, we will take a break. When we get back, we're going to continue the conversation. We're going to talk about how Americans can't get enough of the stock market. Is that good? Is that bad? Is that indifferent? What's the conclusion there? Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Americans are all in on the stock market these days. They just cannot resist. They're so excited. There's so many different options in which to get involved in the market, and there's so many different options beyond just the stock market these, right? You got all these cryptocurrencies, you got all that stuff, and it's just attracting a lot of attention. And Americans today are holding more stocks than ever before. So is that good? Is that bad? Should we be indifferent on that? Welcome back to the program Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you on our original network of News Radio WFLA Orlando, along with 96.9 The Game. And then we welcome our listeners over on the Space Coast. Recently added another station to our reach at 92.7 WMMB. Also happened to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to our podcast on your favorite podcast platform of choice. Just simply look for Nelson Financial Planning and you'll find our channel. If you have trouble finding it, whether it's on podcast or on our YouTube channel, you can simply go to our website at nelsonfinancialplanning.com. Upper right hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and then you will get directed directly to our channel on whatever the platform is that you're looking for. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready to help you change your life with a successful and cost-effective financial plan. So Americans' love affair with stocks is at perhaps the highest level we've seen in some time. Stockholding among U.S. household increased to 41% of total financial assets for the month of April. That is the highest level of stock ownership on record, with data going back to 1952. That includes 401k retirement accounts, that includes all the different types of financial assets. But the highest level on record in terms of stock holdings among U.S. household, peaking to over 40% at 41%. Obviously, the enthusiasm for stocks comes amidst a variety of factors that have certainly been unique over the course of the past 12 months. We've got lower volatility in the overall markets, particularly over the past few months. The S&P 500 hitting record highs these days, and that is being fueled by earnings season, where companies are showing earnings that are much greater than expected as the world and the country starts to reopen post-pandemic. And ultimately, consumers have a tremendous amount of money, cash money to spend. And ultimately, that helps to drive corporate earnings and the market. It also means that they've got extra money, whether it be in the form of these stimulus checks or simply because they weren't able to take a vacation last year. The reality is they've got some extra money. And so ultimately, they're looking for places to put that. And that certainly, again, anytime you have increased demand for anything, you're going to start to see prices increase. So that's part of what is happening. And of course, the backdrop of the pandemic has spurred a lot of online trading. A lot of folks that perhaps might not have been getting into stocks or what have you, this time they are, because there's a lot more platforms that make it easier to do so. Plus, generally folks have a little bit more time on their hands because they're trapped at their houses. That's one statistic. Stock holding highest level since 1952, and that's actually when they started to keep track of the data. So basically, it's the highest level ever in terms of stock holdings as a percentage of financial assets among Americans. Another stat that is maybe a little bit more disturbing than that story, a lot more disturbing really, is that the love affair with stocks is starting to get juiced up by borrowed money, by leverage. So when you think of leverage, that means I'm borrowing money to get more of that stuff, right? The problem is that while that's great when things are going up, it is not so great when things are going down. So here's the stat on that. Investors' allocation to the stock market hit around a 3-year high of about 70%. Margin debt, okay, stood a record as of March north of $800 billion. That is a lot of borrowed money. That is investors that are doing that. And I guess that harkens us back to the old Warren Buffett expression: be fearful when others are greedy. and when you're borrowing money, when you're using margin to buy more and to buy more stock or to buy more whatever it is that you're chasing, you may want to just pause. And that gets us to sort of our theme at the office this year so far in 2021, and it's the theme of rebalancing. And we've certainly talked about this on previous episodes on the program, but the reality is the notion of rebalancing is not that you keep chasing after the thing that's gone up the most, but in fact, it's like the opposite of that. You trim out of the thing that has gone up the most and reset your overall investment allocation to be what it is that you plan for. The market has gone up so much that we're seeing investment allocations that started at 70-30, 70% stocks, 30% bonds, that are now up to like 80% stock, 20% bonds, simply because the bonds haven't really had much performance. Meanwhile, the stocks have really gone up dramatically. So what that means is now your portfolio has more risk to it, and it's not a function of, okay, well, I want to keep feeding the thing that's gone up the most. Studies show that that doesn't work too well. The reality is what you want to be thinking about right now is sort of rebalancing and saying, okay, if a part of my portfolio has gone up so much, I want to trim that back and ultimately maintain the same asset allocation that I'm targeted for from a balanced perspective. So the theme really, and I think more than ever, particularly when you hear those statistics about the highest level of stock allocation, and again, a lot of that's based upon growth, right? So if you're not paying attention and you've got a high stock allocation or a much higher stock allocation than what you really plan for, then that really does get back to rebalancing. The margin debt statistic concerns me a lot, because anytime you bring leverage or borrowed money into anything and you keep driving prices up, ultimately the music stops at some point, and then the fallout is pretty dramatic. Speaking of not getting enough of the market certainly can't get enough of the FANG stocks either, right? Facebook, Amazon, Netflix, Google. And so those companies are really driving a lot of the behavior of what's going on in the market today. In fact, those 5 companies, right? Microsoft, Apple, Netflix, Facebook, Google, those 5 companies, probably going to even toss in Tesla at this point, those handful of companies have driven over 30% of the return of the S&P 500 over the course of the past 5 years. That's why we recently did a blog post on our website at Nelson Financial Planning talking about this very issue, raising the question, and I think it's a question that we've asked on previous episodes of this program, is the S&P 500 really more like the S&P 5? Because when you have 5 companies out of a 500 company index that's driven 30% of the performance, then you have to kind of wonder, is what's going on there perhaps creating a lack of diversification in my investment portfolio? And one of the reasons why that happens is that the S&P 500 is a weighted average. So that means that the bigger the company is, the more it's ultimately going to drive what happens in that index. So make sure you sort of check out our blog post on the website, where we talk a lot more about is it the S&P 500 or is it the S&P 5? Because there's certainly been a big run up in a very small handful of companies that are driving the performance of the index. Coming up next on the program, we'll talk about the different options within the Florida retirement system, along with a disturbing headline coming out this past week of the pension plan not being in as good a financial shape as people believe. All that and more coming up next after this break here on Dollars and Cents with Joel Garris, Nelson Financial Planning. News Radio, WFLA Orlando, 92.7 WMMB. Do you work for the state of Florida? Whether that's as a teacher, a deputy, corrections officer, whatever the case may be. And are you kind of hearing these headlines about the pension plan that the Florida retirement system runs? It certainly should be getting your attention these days. There was actually an article on WESH, which is the local affiliate here in Orlando, that talks about what experts are saying about Florida's massive pension plan running dry. That's a pretty dramatic turn of events for a pension plan that not more than 15 years ago was in pretty good shape. So what's going on there, and what are the implications for folks who are in the Florida retirement system, or maybe thinking about getting a job for the state? What's going to happen to all of that? Well, we'll share with you that information here in this segment of the program. Welcome, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program. Now our reach across Central Florida has expanded. We welcome in folks over on the Space Coast with the addition of 92.7 WMMB to our lineup. We're still on, of course, on our old station that we've been on for 30 plus years over at News Radio WFLA Orlando. And then, of course, for our sports fans, we're also on 96.9 The Game. For those of you who like to catch us on the internet through our podcast, we're one of the top 25 financial planning podcasts on the World Wide Web as well, with over 16,000 downloads of our podcast episodes at last count. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So some background on this Florida retirement system, right? So if you work for the state, you've got two options, and I would say maybe like 2.5 options. So your two primary options are either the pension plan or the investment plan. So the pension plan is your traditional check a month kind of plan, right? Your grandfather's pension, right? It takes the years that you've worked, the service credit percentage, and then your average final compensation, and ultimately creates a number that you're going to get on a monthly basis, depending upon whether you want it joint survivor with your spouse or some other options. Then there's a recalculation of that amount. So that's the pension plan, very traditional sort of approach in terms of how retirement used to work for many Americans 20, 30 years ago. The other side of that, in terms of the two main options, is the investment plan. So what the investment plan is it basically looks like sort of the present day 401k, right? There's a lump sum of money in there that is yours. You control it. You get to take it with you once you leave. And if you retire, then it becomes something that is has the ability to be rolled over and then generate out income to you in retirement, right? I mean, the pros and cons of the pension versus the investment. Pension plan is, in fact, a guarantee by the state. We'll talk about how good that guarantee is, and this article sort of draws that into question. Versus the investment plan, where you control the money. The good news is if you pass, then ultimately that money is able to shift to other beneficiaries that you've named. The reality is, of course, that means you have the investment risk squarely in your hands. The other sort of half option, if you will, is drop, which is the deferred retirement option, whereby you basically, it's really, the drop is really more of an offshoot of the pension plan, because when you go into drop, basically what you're doing there is you're saying, okay, I'm going to retire, but I'm not really going to leave. And then for the next up to 60 months, basically my pension check is going to go into a holding bin. And then at the end of that period of time, I get to take that chunk of money and take that with me. But I committed to the pension plan, so I'm going to get the pension plan, and then I'm also going to get this drop amount as well. So the drop really is an offshoot of the pension plan, because all the money that you're getting when you do drop is just simply a reflection of the amount of your pension benefit that you should have been getting, because effectively you retire when you go into drop, but you're not able to collect your pension because you are still working for the state. So those are sort of the two main options. Well, Along comes the article, and this has sort of been a conversation that's been percolating in the background for many years, particularly after 2008, 2009. Because I think what people sort of forget is that, when they talk about the investment plan, and the biggest negative to the investment plan is, again, you as the individual assume all of the investment risk, versus the pension plan where it's guaranteed, quote unquote, by the state of Florida. Well, the reality is that both the success of both of those is highly dependent upon the stock market, because the reality is that when the stock market goes down, that's when the finances of the pension in fact get disturbed as well, because the pension is not a bunch of cash just sitting in a vault somewhere in Tallahassee. It is money that is invested. And if you look at the underlying investment allocation of the Florida pension plan, you'll find that it's about 70% in the stock market and 30% in cash and bonds. A typical classic growth and income balance type of portfolio. Well, experts these days are saying that the pension plan in Florida is in trouble. This is an article courtesy of Wesh TV, and it quotes a Dr. Adrian Moore, who is an economic expert with the nonprofit Reason Foundation. And here's the story. 20 years ago, the Florida retirement system's liabilities versus assets had a $14.5 billion surplus. So, hey, well in great shape with a pretty good size surplus. After the recession in 2009, it became a $15 billion deficit. So a pretty dramatic swing, obviously a dramatic period of time, but that underscores the impact that the market can have on the pension plan as well. It asks anybody who works for the state of Florida these days, and they will tell you, well, I lost my COLA, and I now have to contribute 3% of my income to my retirement. I didn't have to do those things before 2009. But here's the bad part. So since 2009, the market's kind of been trending upward very strongly. The reality is, unfortunately, that it hasn't bridged the gap. The deficit in the pension plan now stands at $36 billion. So we went from a $14.5 billion surplus 20 years ago. After 2009, as you might well imagine, that swung dramatically to a $15 billion deficit. You would think, oh, market's doing well, things are going well, they must have fixed that. No, in fact, they've only expanded that to now be a $36 billion deficit. And for the 465,000 retirees of the state of Florida system and the nearly 645,000 active workers, that should be catching your attention. And the reality is that you may have to really think through these choices a little bit more. There's a law that is being proposed in Tallahassee these days that would close the pension plan to new enrollees after July 1 of 2022. So you may not have a choice. You may be forced into using the investment plan. Some exceptions on how that would play out, particularly for firefighters, EMTs, police, correctional officers, so those high-risk people would not be forced, as the only option when you come to work for the state as the investment plan would be the pension. But you still have a choice. And so the point of this is to really be thinking through what's the difference between the pension, what's the difference between the investment, and understand that there are risks on both, and which side of the equation do you want to be on. We wrote a booklet about a year ago, and actually longer ago than that, but we updated it about a year ago. It's called The State of Your Retirement, the Essential Guide for All State of Employees. For the YouTube audience, I'm holding it up for the screen. If you'd like a copy of it to learn a little bit more about these issues, go to our website, Nelson Financial Planning, and download the booklet. It's a free booklet. It's about 50 odd pages, so it won't take you too long to read it. But the reality is it's got a lot of good information in there about the differences between the pension versus the investment plan, particularly within the state system. We're going to take a break and continue on with the program after these messages here on Dollars and Cents. In a previous episode of the program, we detailed some of the tax changes that have been proposed in DC recently, and we wanted to delve into one in more detail so that folks sort of understand the current state of the tax code versus this proposal, particularly since this particular tax change that's being discussed is one of the oldest parts of the tax code, been around since almost 100 years. And at the end of the day, it saves taxpayers more than $40 billion per year. Of course, we're talking about the step up in basis, and so we're going to get into describing exactly what that is and how that works under current law as it's been for the past 100 years, and then what some of the changes are that are being proposed and how that might impact you, and some of the things that you may need to be thinking about if that does impact you. So welcome back to the program Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, now coming to you through the full swath of Central Florida on News Radio WFLA Orlando, along with 96.9 The Game. And then most recently, we welcome our audience over on the Space Coast at 92.7 WMMB. Of course, if you're not listening to us on the radio, then you may be subscribing to our podcast. Our podcast is one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast channel of choice. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team stands ready to help you change your life with a successful and cost-effective financial plan. So what are we talking about when it comes to the current tax code? Been around for 100 years, this whole notion of step up in basis. It's saving taxpayers about $40 billion per year. And we're going to talk about here's how it works now and what the implications are. So let's say that you own some stock and you bought the stock 30 years ago and you spent a couple $100,000 on it, okay? And today, fortunately, it's done well, and so that $200,000 is worth now $2 million. Well, you now have a $1.8 million capital gain embedded in that particular position. With rates up to 23.8% on capital gains these days, if you sell it today, you would pay about $428,000 in taxes based upon that gain. Okay, that's how it would work right now if you were to sell it. Now, the reality is something different happens when you pass away, and this is the step up in basis concept that's been around for 100 years. A major part of estate planning and major part of the tax code for obviously a long time. If you die, same situation, right? You got a $1.8 million cap gain. If you die, then the basis steps up to the value at the time of death, and then that capital gain, that $1.8 million of capital gain that was embedded in that position, disappears. So you see how powerful that is, particularly from a beneficiary perspective, is before where there would be an over $400,000 tax bill on it, the tax bill is now zero. So that's the concept of the step up in basis. You die, the basis or for your basis for tax purposes jumps up to the value at the time that that person passes, and ultimately you avoid the tax implications on selling that asset had you sold it while you were still living. What's proposed is something very, very different. Same example, okay? The proposal in Washington is to eliminate the step up in basis. So we'll use that same example. The exemption for the step up in basis is it applies to everything above a million of gain, right? So, but it also flips it from not capital gains rates, but to ordinary income tax rates. So we'll use the same example. A $1.8 million cap gain, the person passes the zero tax. The reality is that if you use the $1.1 million exemption, you still would owe taxes on the $800,000. That wouldn't just be reportable as capital gain, that would be reportable as ordinary income. Top tax bracket for ordinary income these days, 43.4%. So literally now you're going to pay about $347,200 of taxes. So that's a pretty big difference, zero versus about $350, versus if the person had sold it, they only would have had to pay $430,000. And so there's certainly some exceptions in the proposal. For example, charitable deductions, you still get the full amount if you donate those assets to a charity. before you sell them and the charity sells them, then there's no tax implications on it, and you still get the full deduction for that charitable gift. Home sale exclusion still applies, right? If you sell your primary residence and the gain is less than $250,000 as a single person or $500,000 as a married couple, again, no taxes on the sale of a primary residence. This proposal obviously means nothing for retirement accounts, because everything in a retirement account has got to come out as ordinary income, and under those rules, which again just changed about a year ago, you now have to take all of that out within a 10-year period of time. The exemption of the million appears to be on a per person basis. And again, I want to emphasize here that this is a proposal and it is not the law of the land, and who knows what it looks like when it becomes the law, and maybe it doesn't ever become a law, but it's these kinds of things that you want to start to be thinking about in terms of trying to address what might be a possible solution. So some of the things to think about, particularly as this conversation continues in Washington, is, do you sell now? If you've got a position that has a big capital gain, do you consider selling now so you pay some of that gain? So give the example above. If you had that $1.8 million capital gain, if you sold 800,000 of the position, right, it would get you down to that million exemption for your beneficiaries, and that would only require you to pay 23.8%. And so that would be like $190,000. Well, $190,000 of taxes is a whole lot better than $350,000 of taxes that your beneficiary would pay. So I think it does open the door, depending upon the situation, to saying, okay, I'm going to selectively decide to sell something, incur the capital gain on my tax return, and not just simply pass it down to my beneficiaries. And so to try and be mindful of where those numbers are and how the exemption plays out, you may find that in terms of estate planning and how that integrates with the investment side of things and the tax planning side of things. I mean, what all of this is doing is it's requiring your investments, your taxes, and your estate planning to all be much more integrated than it ever has before, particularly as these types of massive changes in the tax code play out. So certainly got to think about, okay, well, do I sell some of this now? Do I gift some of this now? What does that look like? Because certainly also the gifting now proposition, when you gift somebody a appreciated asset, they assume your basis, and until such time as they sell it, then you don't have to pay the taxes on that capital gain. Because what this proposal in Washington seems to suggest is that when you inherit, it's effectively going to be like a deemed sale. Like whatever the gain is, you've got to then pay it right then. You can't just ignore it. You can't just wait. You can't just continue to hold the asset in it and avoid paying the capital gain. The proposal seems to suggest that this is going to be treated like a deemed type of sale. So be aware of kind of how that wording ultimately plays out. The reality is, congrats to the insurance industry on this one. Great lobbying effort, because the reality is what you're going to have is a lot more interest in trying to buy life insurance, because that is still tax-free. That has not changed. And so consequently, you're going to see a lot of folks talking about buying life insurance to help avoid the tax implications of that. So anyway, those are some of the thoughts on some of these proposals that are coming out of Washington. Of course, we'll keep you updated here on the program as things develop, and we'll wrap it on up and get on out of here. Thanks for listening to the program Dollars and Cents with Joel Garris of Nelson Financial Planning.